Hey guys, do you want to have a slice or piece of the top 500 companies on the US stock market? You know, many people have talked about the S&P 500 and this great index on how to create great wealth by using the S&P 500 index. And what is the S&P 500 index? Well, it is a collection of the top 500 companies on the US stock market. And today we're going to be talking about how to start investing into the S&P 500. And at the end, I'm going to give you guys a step-by-step tutorial on how to start with your money, and then at the end, invest in the S&P 500. All right, let's stay to the end to get that step-by-step guide. Hey guys, my name is Steve, and I run the Frugal Expat website, where we try to help people to save more and invest better. And in today's video, we're going to be talking about how to invest in the S&P 500 and what it's going to do for your money. We're going to be talking about how to invest in it, why would you want it, what are the fees involved, and is this a good strategy on starting your investment journey? So the S&P 500 is a famous index that has been tracking the top 500 companies on the US stock market since 1957 when it was created. This index is kind of a health marker, a place where it tracks the entire market. When people talk about the US stock market, they're talking about the S&P 500. Now, you may be wondering, why should I be choosing the S&P 500? Do the great investors do this? Well, Warren Buffett says the S&P 500 should be a great place to invest your money for about 90% of investors out there. That means it's probably talking to you. Now, the reason I say that Warren Buffett says it is because he has suggested it. He says that most people should put 90% of their money into the S&P 500 and maybe 10% in some good treasury bonds for a great portfolio. Now, he actually owned two S&P 500 ETFs until earlier this year when he sold them off, but that means he actually invested in the S&P 500 index. So that is great news if you're thinking about it. I mean, think about, the greatest investor of all time is investing in the S&P 500. Why? Because it has some of the greatest companies in the US. It's got a great track record and it's got low costs. Now, what are some things that make the S&P 500 so great? First of all, it's got a weighted index. So that means the top companies that have most capitalization, so the most money that it's worth, are the top of the companies. So you're talking about Microsoft, Apple, Nvidia, Meta, Amazon, Berkshire Hathaway. You're talking about some of the top companies on the US stock market. Now, these are some great companies that you can buy and hold, but easier way to buy and hold them is to use it in an ETF where you can get not just the top 10, but you can get the top 500 of these companies. Now, that makes it easy because when I look at it and I say, all right, so you have Berkshire Hathaway, I mean, that's an expensive stock. Apple's getting very expensive. Microsoft's expensive. Meta's expensive. I don't have all this money to buy and hold all these different stocks, but I could buy them in an index fund or an ETF that makes it simple and easy. So that's what makes owning the S&P 500 such an appealing thing. And secondly, it's also got some great sectors a part of this market. It's got technology, financials, healthcare. It's got consumer staples, consumer discretionary, and all these things combined create the US market, which means you have a piece of every sector. And it is great because now you don't have to diversify in different sectors. You don't have to have a tech ETF. You don't have to have a healthcare ETF, a utility ETF, an ETF here, a fund here, a fund there. You can make it simple and just buy one, and that is the S&P 500. Now, let's go over some advantages of owning the S&P 500. Now, the first advantage of owning the S&P 500 is broad diversification. Now, you may be wondering why I say broad diversification, because instead of having just one or two or three different companies, you have a selection of 500 great companies that are going to help your portfolio. Now, the good news is if one company goes belly up, well, you have 499 keeping the rest of the fund up. So that's good news. And every year, you're going to have companies that are going to go away. You're going to have companies that are going to be added. So no matter what, this broad diversification helps you with your portfolio. You're not going to have just one or two companies that are going to make your portfolio. You're going to have a whole bunch that are going to continue to grow as the US market grows. Advantage number two is going to be the accessibility to investing in it. Like I said, there's going to be different kind of funds, and these funds are quite cheap, and some of them have higher share prices, but with low expense ratios. Usually, you're going to have about anywhere between 1 to 2 to 3 basis points for each fund, and that just means you're going to have a cost if you invest $1,000. You're going to have a cost if you have a 0.03% expense ratio. For $1,000, that's going to only cost 30 cents for every $1,000 invested, or $3 for every $10,000 invested. As you can see, that's pretty low cost, if you ask me. I mean, that's an easy way to get into the market and not be spending tons of money. Number 3 is going to be solid returns. This index has averaged about 10% per year for the last 100 years and since 1957 as well. Now, that is before inflation. So if you were to take inflation out at a 3% rate, that's a 7% growth rate on this index. That's pretty good, if you ask me. I mean, it's hard to kind of pick and choose and see which stocks are going to do that well over the longest amount of time, and having a simple approach of buying and holding index fund or ETF that tracks the S&P 500 means you'll probably average around 10% per year, and that means some years are going to be higher, some years are going to be lower, but it's going to be an average of about 10% before inflation or 7% after inflation. That's good news. Number 4 reason, it's going to beat about 90% of active investors. Now, that is great news. If you're looking for a way to buy and hold and be passive, it's going to beat most active investors, and that's good news for you. If you're looking for a good simple approach, well, buying it and holding a S&P 500 index fund or ETF is a great way to start your investment journey. Now, there are some disadvantages. So disadvantage number 1 is it is primarily just all US investments. So if the US market were to go down while the international market were to go up, well, you will probably see that in your fund. Your fund will go down while other people that hold internationals will go up. You can see that in 2025. Right now, the internationals are going up while the US market has dragged a little bit earlier part of this year, but starting to go up right now. And you can see that with a good international fund like VXUS, which is up about 18-19% year to date, or even VGK, which is a European index ETF, which is up about 22% this year. Now, the S&P 500 is not up that high yet, but it is going up higher for this year. So that's some good news to you. If you want to do some internationals, there's some great ETFs and funds out there that help mitigate that risk. So that's the only disadvantage of holding just the US S&P 500 index fund or ETF, the risk of just holding just US equities. So if you want to have international equities, there are some great options out there. All right, let's get on to some funds that you can start investing in. Now, some great funds that you could invest in. Let's start off with some mutual funds. So some mutual funds you can start investing with is the Vanguard S&P 500 index fund, which is VFIAX. It's got an expense ratio of 0.04%, which means it will cost you $4 for every $10,000 invested. Now, Fidelity has the Fidelity S&P 500 index fund, which is the FXAIX, which has an expense ratio of 0.015%, which means it's going to cost you about $1.50 for every $10,000 invested. Then you have the Schwab S&P 500 index fund, which is SWPPX, which has an expense ratio of 0.02%, which means it costs about $2 for every $10,000 invested. So right here, you have 3 great index funds that have low expense ratios, Vanguard having the highest expense ratio with Fidelity having the lowest. Now, they each track the same index, so it just matters to you. Which one do you want to pick? Which brokerage account do you already open or thinking about opening? And then just buy and hold and just start investing. Now, there are some great ETFs, and personally, I love ETFs. And so we'll go through a couple ETFs that you can start investing with today. Now, first of all, you're going to have the Vanguard S&P 500 ETF, and that is VOO, and that has a cost of 0.03%, which means it costs $3 for every $10,000 invested. Then you also have the Spider S&P 500 ETF Trust, which is SPY. Now, that has an expense ratio of 0.09%. You also have IVV, which is the iShares S&P 500 ETF, which has an expense ratio of 0.03%, and SPLG, which is the Spider Core S&P 500 ETF, which has an expense ratio of 0.02%. Now, these are all great ETFs, and you can buy them and hold them. VOO and SPY are the 2 largest ETFs actually on the market. So one has an expense ratio of 0.03%, which is VOO, and SPY has a 0.09%. Now, SPLG is the cheapest on this option, so if you want to go with the cheapest, SPLG is the cheapest. I talked about Warren Buffett liking S&P 500, and the good news is actually backed it up with some money. In 2007, he betted a hedge fund manager that the S&P 500 would outperform his hedge fund in a 10-year period. And what happened was he betted $1 million. So in 2017, they took a look at both portfolios and they saw which one was the winner. Now, the S&P 500 in that 10-year period averaged about 7.1% annually growth in those 10 years. The hedge fund, on the other hand, did about 2.2%. So Warren Buffett won doing more passive managing than active managing. So that's good news for you. If you're looking to kind of do more active versus passive, and you're thinking these active funds could outperform because some financial advisors said, oh, oh, I can make this work and I can make you more money than the S&P 500. Well, kind of think about this. Warren Buffett said the passive S&P 500 outperformed a hedge fund manager. So that's big money right there. He bet $1 million and he won. So that's good news to you. If you're looking for something that's passive, simple, and can make you some money, the S&P 500 should be the one to hold you over, and it should be the one that you should pick. All right, we're going to go through a step-by-step guide on how to invest in the S&P 500. Step 1 is to open up a brokerage account. And that means you just need to go online and open up one. Some of my favorites is Charles Schwab, Fidelity, Vanguard, and M1 Finance. And I'll leave links in my description to help you guys out. And I'll also leave maybe a video at the end of the video to show you guys some of these best ones and how I break them down. All right, number 2 is to deposit money into your account. That means putting your money in and actually investing into the S&P 500. Some people just put their money in and just hope it's actually get invested. No, you need to buy actually the investment. And one of the investments you should pick is probably the lowest cost one that you like. Maybe it's an index fund, maybe it's an ETF. Personally, I like ETFs, and so I'll probably choose either VOO or SPLG. Those are my 2 favorites. Number 3 is the dollar cost average. What that means is to constantly put money in and continuing to buy and buy. That means maybe you do it once a month, maybe twice a month, maybe every day if you want to, or even once a quarter, but continuing to buy. So when those market downturns happen, maybe your dollar cost average, you would take advantage instead of your money just kind of just going. Well, you're continuing to invest and you're continuing to build that portfolio for the future. And number 4 will be to observe your portfolio at least once a year, see what it's done, and see if you need to kind of adjust into bonds, into dividends, and think about the ways you want to kind of diversify and correct your portfolio. So that's a good 4-step guide on how to invest in the S&P 500. And that is a little bit about the S&P 500. Let me know in the comments, do you like the S&P 500? Do you invest in other broad market ETFs like VTI or SCHB? And I'll also leave a video up here to help you guys to invest in a Roth IRA. And so these are some 5 accounts that you can start investing with today. All right, that's a little bit about this video. So I hope you guys have a great week and a great day. Until next video, I'll see you guys.